Inflation is out of control. The Fed makes huge announcements. And will the millennials save the housing market? That and more coming up. This is the Brandon Mulrenin Show. All right, so the big news is inflation at 6.8%. Highest it's been in 30 years. So first thing I think that's important is to unpack, like, what is inflation?
Yeah.
Why does it matter?
Yep.
So the good people at home can understand, like, when they go to get gas tonight,
Yeah.
why gas prices are so high.
Right.
When they go get a gallon of milk, why is it so high?
Right.
So
maybe
first,
why is it bad?
Yeah, exactly right. So let's talk about what is inflation.
So I think the easiest way to describe inflation is it's things costing more money.
Sure.
You know, like the prices of things are inflating, you know, for the same thing, right? So if you're getting something better, then you're upgrading something, you wouldn't call it inflation. But if last year, if a gallon of milk cost you $3.03, right? That was like the average gallon of milk last year. And the average today is $3.72. So you'd say that milk has increased, or the price of milk is inflated by 19%.
Got it.
From a year ago. So it's inflated, right?
Yeah.
For the same exact product. So that's what it is. It's not for different products or better products or anything like that. It's the same product costing more.
So I think, and that makes sense. And so I think we have to explain why this is happening. Okay. Yeah. So when we were talking off air, this is really a story of the people understanding at its core, supply and demand and how the whole thing works. Okay. Yeah. So when we were off air, I was kind of talking through this, but let's look at, let's first give an example of like why people believe holding on to cash during a time of inflation, when inflation is high, why that would be a bad thing. And then we'll give examples on why the gallon of milk costs more now.
Yeah. So I think it's important too to start with why, like what the initial thought was on inflation and like, why is it all of a sudden becoming such a big deal, right?
Yeah,
so
I love it.
If you rewind a year ago when we were talking and doing these goofy videos, we were sitting at home doing Zoom and making fun of Bill, and it was fun and all that stuff. But you go back to that time, and that's
where is Bill? Did he call in sick again?
Bill's tired. Dude,
Bill's
tired
the only again?
He's the only adult I know that when he gets tired, he doesn't come.
So this is a 3-person show, but you only continue to see 2 of us. There's supposed to be a third anchor. Are we anchors?
Yeah, we're anchors.
All right.
I'm an anchor. You're for sure an anchor.
Am I a journalist or an anchor? But there's supposed to be 3 of us, but our partner in crime keeps calling in sick. But anyway.
He had a virtual meeting today. I'm like, can't you virtually move your meeting ever? But he can't.
Anyways.
It way outweighs us. So anyway.
You're going to see another bald guy in the future is the point.
So here's the thing though. So why do we have inflation now, and what happened? So for what happened a year and a half ago at the beginning of the pandemic is the Federal Reserve, they lowered the rate. They started doing these asset purchases, which we'll get into, these asset purchases and things like that. But they did that to lower the prices on goods. They wanted to not lower the price on goods, but I shouldn't say that, but put more money in Americans' pockets, right? They wanted to lower all these rates, get people to borrow money. So everybody did, right? You can borrow money at ultra low rates. Let's start buying things. Well, then we had like you've seen the memes online, you know, where you're like tracking this year's Christmas presents, and it's like a guy in a kayak and there's like a bunch of boats in San Francisco. Like we had this huge supply chain backup, right? And then there's a shortage on chips, and all these things are going up in price. So we have all these things coming. Well, the Federal Reserve kept coming out and saying, like, don't worry about inflation. We're going to keep on with our same program. It's transitory, right? So what transitory inflation is.
Here comes a bunch of big words.
Yeah, right. Transitory is a huge word. There's like 4 vowels in there.
I'm going to make this easy for you to understand, I promise.
No, so I'll explain it. So here's what happened. So they said, we expect prices to go up. We expect people to spend a whole bunch of money right now because for the last year, we've told everybody, stay home. We're going to continue to pay you. You're going to get increased unemployment benefits.
COVID money.
You're going to get that COVID money, right? Like everybody's getting a boat. Like I have a neighbor literally has 1 jet ski, 9 kids, 1 jet ski. I'm like, it's so out of place. That's COVID money.
Sure.
You know? But they, so they're like, we plan on people spending all this money because they've all been saving it because you can't go anywhere. There's this pent up demand. So they're just going to buy it all. Well, the problem is like that came and went. We're like, oh man, inflation's not going down. So now we have this huge number for inflation. So that's where we came. That's where we're at today. Like transitory is gone. Like inflation's here to stay. There is a massive demand that came from a bunch of different things, and there's a shortage of supply, right? So there's
I want to talk about I want to talk about why that is. So because here's someone is at home in their Christmas jammies watching this. I guarantee it. There's like one of you watching this video. I promise. Hopefully there's more. But because if you guys like the show, give us a little thumbs up.
We appreciate that.
We do appreciate that. The whole supply and demand. The reason why the Fed kept interest rates so low, you nailed it, was to motivate spending.
Yes.
What happened was the pent-up demand was so great that the suppliers of goods, restaurants or the housing market, farmers, anybody that was supplying any good or service, like they didn't have enough because people were spending so much, which is causing a supply shortage.
Yeah.
When that occurs, the supplier, and fill in the blank, it could be any supplier, is forced to then do what with their prices?
Right.
They got to raise the prices, right? And so what's happening right now, and so let's get into the cash thing.
Yeah, that's
so now what happens is inflation goes up, cost of goods are going up because of what we just said.
Right.
So now when that occurs, when inflation's sitting at 6.8%, talk to us about why holding on to cash right now might be a bad idea.
Because stuff is better than cash, right? So an asset. So if you're in a time of inflation, so if you have cash in the bank, right? So you have your checking account.
Yeah.
Say,
let's do the $10.
Yeah. So Brandon Mulrenin has $10 in his bank account, right? So that money it doesn't get anything, right? That money doesn't earn anything. It's just sitting there. It's great. You're excited. You've got your $10, right? Well, the reason cash is bad is because especially in a high inflation environment, is that last year you took your $10 out of the bank and you went and got your gallon of milk and you bought it and it was $3.
Okay, I got that down here.
You come home.
So $3 last year, gallon of milk, $3. You got $7
$7 left in your bank
account,
account, right? So that's the same thing. Well, that gallon of milk now, let's just call it $4. And I think even in some places it's more than that. In that, the increase of the gallon of milk is a myriad of things, right?
Sure.
There's higher energy costs, gas prices, labor shortage, all the problems that we're saying with the demand are falling out of the supply falling behind the demand, right? So now your gallon of milk, in some case, $4.50 a gallon. Okay. So now when Brandon goes and buys his milk, he has the same $10, right? Because it's not earning any money. It's not subject to any of the increases in value. It's just cash. So that cash is sitting there. Well, now when you go buy your milk, you're getting your same jug of milk, but you're only going to have $5.50 left instead of your $7. So that's why you want to take, that's why they're saying now debt is good when it's cheap, like it is now, or interest rates are low, which is why they're doing that. Go buy things.
Right.
Borrow money, buy jewelry, buy cars, buy all these different items because they're going up in value because there's a lot of demand.
That's right.
And there's not a lot of it out there to get.
Yeah.
So that's why there's so many talking heads right now that are saying like having your money sitting in cash right now is the worst thing you can do in this environment.
Yeah.
And that's why.
That's exactly right. And that's a great point. So the same cash you had in your bank account last year when inflation was lower, now your same cash is just worth less.
Yeah,
right?
Because it's getting you less stuff.
It's getting you less stuff because things are more expensive. So I love the milk analogy, right? Let's talk about restaurants. This is something that's impacting everybody across the country every single day. So a lot of restaurants have like these, even Starbucks has reduced hours, okay? This is another thing. We're talking about Starbucks or restaurants, it's still going to apply. So this whole thing with inflation and how that impacts the everyday life of people going to eat and going to grab their Starbucks, right? Only the drive-thru is open at my Starbucks right now.
It's crazy.
They can't find people to work, so let's talk about why. So again, we go back to this supply and demand. Demand is really, really high because interest rates were so low, people have money to spend, right? Well, that's putting huge pressure on the supplier. In this case, let's use Starbucks.
Right.
I don't know about you, but every time I go to Starbucks, the line is out to the road.
It's insane.
Okay, there's not a better example of demand than that. And
Did
everybody
people not get coffee before? Like how, have you, ever since the pandemic, it's like, I talk about it with my wife all the time, like, how is it that before COVID happened, you just roll through that Starbucks, maybe like 2 or 3 minutes in line, but since the pandemic happened, that line is out to the road. Everybody's like, because COVID's here, I'm drinking coffee.
No, it's not that.
You think it's the money?
Yes, it's what we're talking about.
Okay, all right.
Because the Fed, which we're going to talk about that in our next segment, the Fed made it so easy to get money. The government made it so easy to get money. So people have more money now than they did before, and now they're going to spend it. So rather than make coffee at home, we've got this money burning a hole in our pocket.
Yeah.
I'm going to go get the Starbucks. That's the reason. Okay.
I just thought everybody wanted to have more coffee.
so now the lines are out to the road at every Starbucks across North America.
Yeah, for
and
sure.
Starbucks like, okay, we don't have enough supply for you. And because people were off work for so long, they have to now, they have this whole issue with finding good people to come and work, right?
Well, a lot of that with finding people to come work for you, and something that's left out a lot in the inflation conversation is that wage growth. Like wage growth
is at, let's talk about it.
Is at an all-time high. So wages are really growing, right? So now,
because let me just interrupt you for a second. The reason why wage growth is what it is because you had a lot of people not at work. So now you have to incentivize the people to come back to work.
Right.
So you have to pay them more, which is causing prices to yet again go up.
Right. Absolutely. And there's mandates too on how much minimum wage can be.
That's right.
And again, and I think a lot of, just looking at the psychology of it, I think people during the pandemic and when they were off work and they couldn't work realized like, hey, I wasn't happy doing that. You know, maybe these jobs, I mean, I look at a barista at Starbucks and I'm like, whew, I could never, you know.
Oh,
like,
I would love it.
All that going, they got stickers in their hands and they're wiping off. I know, but they're wiping off.
You and I working at Starbucks, dude, we would tear shit up.
No, we wouldn't. The line would be 12 miles long. We would not know what's in it. I always thought it'd be funny if I worked at Starbucks. Like somebody's like, I want a double chai soy. I would just literally go back there and just make them whatever I thought. We would like, I don't know. What do you mean? You got the wrong one.
We would get trained up.
Yeah, I know, but I don't think we could. I think it's a lot harder job. I think they're wildly underpaid.
Well, but not again, anymore. They're getting paid more.
I know. I'm just saying. I think that a lot of people though have. I think people's like self-worth has changed, and there's like I know people too that have gone from working one job before COVID, left that job, and come out of COVID making like $20,000 a year more in the same type of administrative role. I mean, there's companies out there paying big dollars for people right now, and again, it comes from. It comes from people having the money to spend.
It comes from
like
the
people,
demand.
there's demand out there. So now it also puts employees in a position with leverage instead of employers. So now they're shopping these employers.
Big time.
Which is, again, it all comes back to the consumer and the people that are paying for these things.
Yeah, you know? to kind of put a bow on this segment before we talk about the Fed meeting and what they're going to do about this entire thing that we're talking about, is again, you rewind the clocks. COVID hits, people go home from work. Everybody's shutting down. The U.S. economy like pushes pause, right? Yep. So everybody goes home. Everyone's getting money, and the Fed is forced to lower interest rates to get people back out there to start spending money. But people didn't want to go back to work, and so as that demand rose again. Employers were like, shit, dude, we don't have anybody to work. Like, we're going to have to pay more. And now, to your point, people, the employee has a lot of leverage that they didn't have before to try to catch up with all the demand, right?
Yep, exactly.
So the Fed met. Let's change gears. So the Fed meets this week to talk about what the hell, what are we going to do about inflation being at 6.8%? People potentially now in a position, it's like, well, geez, I can't keep paying these prices. Car prices are outrageous. Home prices are outrageous. Gas prices outrageous. I won't be able to buy my gallon of milk soon because people are holding onto the cash that's worth less money. All right, so the first thing I want to talk about is the impact that one of the big announcements that the Fed talked about in their meeting was like they're tapering off of mortgage-backed securities. And I want to unpack that, and then we'll talk about what impact that has.
So this is a great time for everybody to get a blanket. Get comfortable.
Get comfy. There's going to be a lot of stuff happening.
Yeah, you're going to get real bored here really fast. So
don't worry, I'm going to make it fun. He's the boring guy, I'm the fun guy.
So here's the thing. So to talk about like what these asset purchases are, and and mortgage-backed securities and all these types of things. So just to try to take what that is and how that applies to you and I, right? And everybody else that's watching this.
But to your point, it is important. Like all the boring shit you're going to get into, it is important.
So thanks for the validation. So what it is so there's a market out there, right? So if you have a 30-year fixed rate mortgage or you have a 10-year treasury mortgage, those are investment tools, right? So investment advisors and different large portfolios, these investments are very safe. They're long-term bonds. They rarely default. They provide a low rate of return, and it's part of an investment. You got to diversify, right? That's like that's the funniest old adage. Is like always like you got to diversify your portfolio. Like
I feel like
that's
people
part of that.
I feel
portfolio.
like people say that when they don't know what they're talking about, so that
The
they're never
diversify.
wrong.
Yeah. Well, it sounds like you have a guy.
Yeah.
You know. So anyway, but it really is like a Fisher Investments ad.
So let me clarify something for the people that maybe have a tough time understanding that. So what you're saying is that from an investment standpoint in the markets, that the safest route for people to put their money is historically like a mortgage-backed security.
Yeah,
that's
like
what you're saying.
Yeah, like a United States Treasury now.
Because it's safe.
Yeah, and they're one and the same in the way they're looking at it.
Yeah.
So here's what happens. So when a recession happens, right? So we have the pandemic, or we have what happened in 2008 and 9. All of a sudden, what happens is people are either they're losing their jobs, they're losing income, they have less money coming in, right? So if employers can't provide people more money, right? Like you can't go into work and you're not getting paid and you're on unemployment, whatever it is, how can the government get more money into the economy? Because that's what happens in a recession. A recession is less money being spent in everyday life. It's less people buying coffee. It's less people buying cheeseburgers.
It's the opposite of what we just talked about in segment 1.
So what the Federal Reserve does is they said, okay, we're going to come in and we're going to buy mortgage-backed securities, and we are going to buy 10-year treasuries. So we'll just call them mortgage-backed securities that way I don't have to say that every single time. But what the Federal Reserve is, what they do is they come in and they buy these bonds, right? So when mortgage companies and lenders in these secondary markets and all these boring things that nobody cares about, so when they originate these mortgages, like, hey, we have a guaranteed buyer that's going to buy $30 billion in these a month. We don't need to charge 4 and 5% on a mortgage. We can charge like 2 to 3% on a mortgage. We know somebody's going to buy them regardless of what the return is on this investment. So the government comes in, they're like, give us more. We have a huge appetite for these. So they do that, lowers everybody's mortgage rates. And then the conventional lending, in most cases, they're going to go out and they're going to make it easier to qualify for mortgages, which they did through forbearance or like expanded underwriting rules. So you can qualify for these mortgages. What it does, it lowers your monthly payment, right? So it's reducing your interest by sometimes 1% on $200,000. It's $2,000 a year, or $170 a month that they're putting back in your pocket, right?
Yeah.
So now, like you said, rather than going to Costco and going to the coffee grinding thing, they got the brush, your fingers smell like coffee for 48 hours. Now, put that 170 into Starbucks or whatever you're going to do. So what they're doing is they're putting more money in people's hands so they can go buy things, and they're creating demand because people have more money.
So that's what has occurred. That
is what has occurred. Yes.
So now we're up to
the mortgage-backed security part of it. So here's what happened
this week.
So the Federal Reserve is saying, okay, we got a problem.
Yeah.
Like Houston, we have a problem. Inflation, for some reason, is now the highest it's been in the last 30 years, right? Inflation is through the roof.
But not to forget, we're here because they had to solve a different problem.
They had to jumpstart the economy.
Now we have the opposite problem.
Right.
So you guys are with us.
So going back, so this is a tool, right?
Yeah.
So buying these mortgage-backed securities, you have a recession, right? Like your car's wheels fall off, right? So the economy's wheel fell off. So they're like, we're going to go into our toolbox. We're going to buy all these mortgage-backed securities and put the wheel back on.
Yeah.
Well, it turns out that they kept buying these mortgage-backed securities, a little bit of a supply issue, a little bit of a backlog. Well, all of a sudden, you put this wheel, you thought you were putting a wheel back on a Ford Escort, and you have a Ferrari.
Yeah.
Right? So there's tons of money in the economy, and there's not enough demand. So the Federal Reserve says, we got to pull back.
Not enough supply.
Exactly. Yeah, I'm sorry. Not enough supply. So the Federal Reserve comes back and they say, okay, we're going to taper these bond purchases. And they can't stop them because the markets will go into a frenzy. Everybody will freak out.
Yeah.
And people will be like, mortgage rates are going up. I'm just going to stop paying I'm just going to stop paying my mortgage. Like everything freaks out, right?
Yep.
So they're tapering, right? So they started off this year. They're like, we know this has to happen.
Yeah.
Like at the end of the summer, like, we know we have to do this. They're doing it. They're reduced it by $15 billion a month, right? And they're buying at least like $30 billion a month right now, which is a crazy thing, right? Or 120 billion. I don't know what it is. I digress. So however much they're buying, like they came around, they said, okay, so we got these really hot inflation numbers from what a consumer pays, what a manufacturer, like what companies pay for goods. So the Federal Reserve said, hey, we're going to double up. We're going to reduce these bond purchases by $30 billion a month, and we're going to be totally out of the bond purchasing game by March of 2022. So what they're doing is they're taking their wheel off your Ferrari, and they're like, we're putting that back. You know, we're going back to the Escort. And letting the market determine what these are, which is going to, so what'll happen is with the government no longer purchasing all these securities or these bonds and all these things, it goes back to market rates, right? So now in order to get an investor to buy them, what do you have to do? You got to provide a higher rate of return, right? So then you're paying a little bit more on your mortgage. Is it going to be a lot? Absolutely not.
No.
Like,
so let's talk about the Fed fund rate and
Yeah.
the forecast to raise interest rates
Yeah.
in 2022.
Yeah.
Because all of that, the tapering off causes the Fed to raise interest rates. And the reason for that is because we have to get these suppliers to catch up with all the demand.
Exactly.
So
100%.
let's get into that. So the Fed meets this week, and the vast majority, if not everybody, says we all agree that we need to raise interest rates.
Yes.
Everybody, right?
Yep.
Everybody on the
Yep.
board decided that was going to happen.
Yes.
To which degree? Let's talk about that for a second. So some were saying, hey, we're going to raise a quarter. Some said a half. What were the projections based on the meeting on how high rates could get in 2022?
So, I mean, ultimately, that Fed funds rate will probably be, by the end of 2022, they plan on raising it. The majority of the Fed shares, so there's 12 dudes that all get together, and guys and gals.
How do we get on that?
We don't. They don't want anything to do with us.
Okay.
So, so they meet, and so they all vote on it, right?
Yeah.
So the majority of them voted that they'll raise rates 3 times in 2022. So what'll happen, they're going to stop the bond purchases so you should know the Fed meets 8 times a year,
Yeah.
right? So they're going to be done with their mortgage-backed security purchases and all that at the end of March. And the Fed's going to meet, and they're not going to be like, okay, this is done. Let's start messing with rates and let's get that going. Like, they can't, because the markets are really emotional.
Yeah.
You know, these people, like, the markets are up and down, and it's all big because there's nothing more emotional than money, right?
Absolutely.
Nothing evokes emotion like money.
Yeah.
So the markets are exactly the same way. So what the Fed will do is at the end of March, they'll be done with their bond purchases, and they're going to let it settle down.
Sure.
They're gonna be like, let's just see what happens with the water. If it's rocky, maybe we'll wait to raise these rates. But ideally what they'll do is they'll start to raise the Fed funds rate 1/4 to 0.5% at a time. They'll probably start at 1/4. And to relate this to anybody watching this video that like owns a home, that does not mean mortgage rates are going up. It has zero to do with that. As a matter of fact, when they start to raise that rate, usually the stock market gets a little bit scary because that stops like corporate expansion and business lending.
Yeah.
Stock markets go down, people move from the stock market to the mortgage-backed security markets. We usually see a little bit of a dip in interest rates. So if you're ever looking at doing a refinance or you're thinking about buying a house and you want to act like you know something, save this video forever.
That's right. Forever.
Watch it, be like, oh yeah, the Fed's meeting.
Yeah.
Maybe I won't lock my rate. Maybe I'll refi this time of the year. Anyway.
So hold on. Let me just kind of
I just go off track. I go right
it's
into
okay.
mortgage.
It's great.
Every,
I know. It's not all
I love a
everything's
good
about
mortgage.
you.
I love a good mortgage.
So the reason why this is the thing that people need to understand, because this is the questions that you and I get every day from just everybody, right? Why in the world would the Fed want to raise interest rates? Because that's the thing people don't understand. The reason for this is their direct impact to lower inflation. The reason why they're raising interest rates is to slow down consumer spending.
Yes.
Now, the person who's watching this is like, why in the world would we want to do that?
Yeah.
It's because we have to bring prices. If you want to pay less for things, the Fed has to stop giving away money. That's what the whole story is about. How they get you to do that is by raising the interest in which they lend money. I mean, that's the bottom line.
100%.
When that occurs, the spending slows down.
Right.
Now Starbucks can catch up.
Right.
That's the whole thing. Would you agree?
Yeah, 100%.
And so when I look into layman's terms, I'm like, that's the way I relate all of the economic, babble into like everyday life.
Yeah.
If you want to pay less at Starbucks, you want to pay less for a gallon of milk, you want gas prices to go down, the Fed must raise interest rates so that people stop spending money.
Right.
And so there's a balance. We're not talking about shutting off the valve. It's a balance, right? We're trying to neutralize the market because their goal with inflation by the end of 2022 is to bring inflation from 6.8% down to 2.6%.
Right.
That was the Fed's goal.
Right. So there's a couple things to know. It's like, I think that a lot of people.
I feel like my explanation is so much better than yours.
Well, I still don't think people know what the Fed funds rate is. Like, what is that rate? And
it's the rate at which people borrow money.
No. It's the rate at which banks borrow money.
Yeah.
Right. So that's what matters. Right. Well, banks
when I said people, I meant
to lend companies, right?
Yeah.
So like
institutional.
If a company wants to fund a huge project, they're like, okay, I can borrow money from this bank really cheap overnight.
Yeah.
So by raising that rate, companies borrow less money. when they're doing that, there's less innovation, right? Maybe less product or less things coming to market, which decreases their stock price, which for them to get their stock price up, they decrease the price on what they're selling, right? And then that decreases those prices while also letting demand catch up or supply catch up. The companies are putting out less product, and now they're worried about, hey, we need more sales. We need more people buying our things. And in order to do that, what do? Make it more accessible. You decrease your prices because they're not getting these quick loans.
It's a constant balancing act. And that's what's happening. So like going back to the, what the Fed fund rate is, it absolutely is the rate at which institutions, sorry, I said people.
Yeah, it's not people.
To play on words.
It's not people's.
I mean, institutions are people.
Institutions not a person.
People run institutions.
Fine, I'm just saying.
Institutions borrow money.
Yeah.
When that goes up, then when the consumer borrows money from an institution, potentially, they're paying a higher rate of interest.
Yep.
All right, so that's the goal. So those were the big takeaways from the Fed. Now, I want to switch gears one more time. I want to get into our third segment, which is housing market. Okay, so are the millennials going to save this housing market crash, which is not going to happen in 2022?
Yes. Thanks for tuning in.
All right. Thank you guys. So here's the deal. So this is just more data-driven activities that people like you and I that cause us to believe that there is no housing crisis coming.
No.
That quite the opposite, that based on new information, millennials are going to supercharge the housing market, which is the report that the Wall Street Journal just released, which I thought was a great thing. So let's give some context, all right? So first, when we look at a housing bubble, housing market crash, to give context, it has everything to do, hopefully you get this by now, supply and demand.
Yeah.
When we look at the supply of homes in a real housing bubble, 2007, 2008, the biggest crisis we've ever seen, there were 3.7 million homes for sale.
Yep.
To give context today, we're sitting at 1.2 million homes for sale. And when we look at the millennial information, which we're about to unpack in a second, this is the thing that's driving home prices, that's driving the home market.
Right.
And based on the data suggests that the millennials, and I'll just read this to you right now, is that for years and years and years, people believe that millennials were like never going to buy homes, right? They're just like these free-spirited people that were going to go and rent forever. Well, quite the contrary happened. I mean, they made up for over half of the home purchases this year.
Yeah. And
the data suggests that it's going to be even more.
They're going to be the leaders.
They're going to be the leaders. And the reason for that was the average home buyer was 33 years old.
Yeah.
Right?
They just waited.
They just waited.
They saved up their money. They got it's kind of interesting, that we're here, Generation X. I don't know how all the generations and the labels work, but so many people thought here's the millennials, they're just going to live, they're just going to rent forever and they're not paying attention. But meanwhile, the millennials over there getting their life together.
Yeah.
Until they're 33.
It took some time.
Yeah, getting a career, saving some money, figuring out where they want to be, and then they're buying homes.
Yeah.
Right?
So here's what's happening, right? So first off, millennials from 81 to 96 is what they're considering a millennial. So I'm a millennial. Come to find out. So are you?
That's awesome.
See, we got our shit together.
Oh yeah.
So again, like I just mentioned, people believe that they wouldn't be millennials wouldn't buy homes, but instead, since 2019, they surpassed baby boomers to become the largest living adult generation in the U.S., which we got, right? So in addition to that, they accounted for more than half of the home of purchase applications last year. And next year, when we look at people turning the age of 33, is going to be more than it has been this year, suggesting that the demand is going to increase, not decrease.
I think there's, part of the data that we read on that too was showing that in 2007 there was 116 households in the United States, or 116 million households in the United States. So each one of those households, ideally is going to produce a home buyer, right? It's kind of what they're saying, right? That's a home buyer. And in today's market, they had 116 million households and 3.7 million homes for sale, and we had a bubble. Well, today we're at 128 million households in 2020, and we have 1.2 million homes for sale, and we have we missed 10 years of home building. I mean, in a year, we can go from start to finish on about 500,000 homes a year.
Yeah.
Creating creating supply, right? So we're short, you know, 4.5 to 5 million homes right now. We can only produce 500,000 a year, and the amount of people going to buy homes are increasing. So it's like it's going to be such a long time to catch up that we're never, whether it's a bubble or not. You can't call it a bubble because a bubble is going to pop. Where this is just going to continue to go, and then eventually it's going to level off. You know, which we're starting to see. Prices went way up, right? And now we're starting to, we're still appreciating, but it's just at a slower pace.
That's right.
Which is good.
Yeah, and the interesting thing is going to be some of the new information coming out suggests that demand will be higher in 2022 than it was in 2021. So if we don't see a big increase in supply from potential home builders, well, I mean, some may argue that appreciation will still get skyrocketed.
Crazy.
It's going to be crazy.
Yeah.
So before you leave, subscribe to the channel, like this. Please, if you like the video, hit that little thumbs up thing. And then if you have questions about the content that we cover in this show, use the comments beneath this video. And if you have recommendations on what you want Steve and I to cover in future videos, we'd be happy to do it. So thank you guys for your support. Thank you for watching. We are out.
See ya.